Hi, everyone. We are back for another episode of Untangling Climate Finance. I'm Jay Tipton from Gordian Strategies. So everybody is familiar with insurance, whether it's medical, home, auto, or life insurance. We all rely on it normally for peace of mind, knowing that if something unexpected happens, we're covered. Insurance allows us to take risks, make investments, and move forward with confidence. But when it comes to carbon markets and carbon credits, the concept of insurance is still gaining recognition. Yet, as the world becomes a more challenging place to develop carbon projects due to political uncertainties, a warming climate, and increasing risks from natural disasters, insurance has never been more important. Without proper risk mitigation, investors hesitate, projects struggle to scale, and carbon markets remain underfunded at a time when we need them most. Well, that's where Kita Insurance comes in. In this episode, I speak with Natalia Dorfman, who's the CEO and co-founder of Kita Insurance. We explore how insurance is unlocking capital for carbon projects and building confidence in climate finance. Natalia shares how her background has led her to this space, why carbon credit insurance is critical for scaling climate action, and how Kita is helping investors and developers manage risks, from delivery failures all the way to political uncertainties. But enough from me and enough of this setup. Here's Natalia to tell us more. Hey, Natalia, welcome to Untangling Climate Finance. How was your weekend?
It was good. Thank you very much. It's a pleasure to be here.
All right. So to kick us off, I'd love to hear a little bit about yourself. So why don't you tell me where you're from, maybe your career path, and how you landed in the climate change space?
Okay. So I am from Southern California, which actually in terms of how my weekend was, it was a very icy weekend. I now live in the UK, and my Southern California roots make it very hard for me to walk on ice. But my children had a great time. My career history prior to getting here, like I said, grew up in Southern California. I went to Duke, where I studied environmental science. I then never worked as an environmental scientist. I ended up first actually doing a stint in publishing. I do think reading, writing, editing, I actually quite love it. I think it's all part of storytelling, which is very important to business. I did that for a year, and then I fell into the career that I did for 15 years, which was doing business development and strategy at international law firms. And so I was fortunate to travel while doing that role. I worked in New York, then in Brussels, and then in London. And in London, I spent 8.5 years at a law firm called Clyde & Co., which is one of the world's largest insurance-focused law firm. And so that's where I really learned the insurance industry. I worked with a lot of the world's largest insurance and reinsurance companies. And then over time there, I was promoted up to global head of new business. And in that role, I came back to which had always been a personal passion around climate change. And I led the business development strategy for the firm's climate risk practice. So how we engage with our clients, whether they were insurance companies or the other clients of the firm, which were often commodities traders, aviation, construction, shipping, in terms of looking at how the increasing regulations and liabilities around climate change were impacting their behavior, whether they were looking to mitigate liabilities or capitalize on opportunities. And that is what led me to think, actually, all I want to do is focus on climate change, whereas at Clyde & Co., which is a wonderful law firm, but is only part of my role. And so I decided to leave there to look for how I could really devote myself solely to climate change for the rest of my career. And that was the original genesis of which led me to Kita.
Beautiful. So you've had a very long journey through the climate change space, I would say.
I mean, it's been circuitous, which I suppose often I think people's roles and experiences are as you get older. You don't just often go in a straight line.
So true.
So I've gone around houses a bit, but working in law firms has been great because I'm not a lawyer, but I worked with all sorts of different types of law and different types of industries. And I had to develop at least some basic knowledge in each of them in order to help sell the legal firm services. And so it was actually a really excellent job that has prepared me in many ways for many of the things that I do now.
That's great. And you're right. That's usually how it works, right? It never goes in a straight line, but we always pick knowledge and information up along the way that in some way circles back to benefit us in our current role or a role that we didn't exactly imagine ourselves being in. It's such a common path, I would say.
Yes, I agree. I always like really speaking to people and understanding their path because it's always interesting how people end up where they are.
Yeah. Well, I used to work in Hollywood. I was a documentary producer for a long time. And like a lot of people kind of responded to the ringing bell of climate change. It was like, I need to make a career change. And that was a bit of a journey in itself. But, I speak to so many people that did something before and have then made this change because they feel the urgency, or just organically they pivot through it without even knowing that they're doing it sometimes.
Yeah, I completely agree. And it sounds like you should be on a podcast to talk about your background. I remember feeling it was a bit like that ostrich with your head in the sand. It was either I'd always cared about climate change in my personal life, but I thought my professional life could be focused more on, what's intellectually interesting, what's a kind of good work-life balance, based on where I was in my life. And then that came that moment where I thought, actually, I've now come back around to learning so much around climate change. We worked with academics and scientists and people in business and regulatory, spaces. And I just thought it's so important. It's just so huge that either I need to figure out how I can make an impact, even if small, but how I can focus, or I'm going to need to ignore it and just sort of put my head in the sand and assume someone else is going to deal with it. And I think that approach feels scarier. It feels more empowering to take some form of action.
Could not agree more. 100%. So, okay, let's discuss Kita Insurance. Why don't you explain what the company is and what your key focus areas are?
Yes, of course. So we are an insurance company. Why don't I quickly tell you actually just where we started? I sort of told you when I left Clyde & Co. But if I tell you where and why we started, I think that then helps explain a little bit what we do.
Yeah, please do.
So I left Clyde & Co. and I joined Carbon 13, which is a venture builder for climate tech companies based in Cambridge in the UK. And the premise of Carbon 13 is to bring together high quality people who are interested in starting a company that can remove millions of tons of carbon dioxide from the atmosphere. And so I joined Carbon 13 again because I wanted to, focus on climate change. And I thought entrepreneurship is a way to do that. And I had no intention of starting an insurance company. I thought I would be the CEO to some kind of technical genius who needed some help in, commercializing their technology. Because I'd worked with all these insurance companies and I knew what a lot of the insurance industry was doing in climate change at that point in time, which was often, in essence, they like to understand a new risk so they can exclude it from existing policies. And it'll take some time before they then pivot and think about how do we take this new risk and create a new policy out of it. So I'd worked with a lot of the insurance companies. And when I was speaking to people at Carbon 13 who are looking at building these technologies that could remove millions of tons of carbon dioxide, I would always ask them what I thought was a relatively simple question, which was, well, how are you going to get insurance? And have you considered what types of insurance you would get that's specific to this new technology? And no one had ever thought about it. People looked at me like I'd grown another head. And so it started to become evident in my mind that the lack of specific tailored insurance for this space was going to be a roadblock, in essence, a ceiling to growth, because it doesn't broadly exist. And people didn't even know that it didn't exist. And so they didn't know that at some point they're going to move past grants and venture funding and, need to access some form of project finance or debt finance. And without some form of insurance, either for themselves or their investors or financiers, you are going to hit a ceiling to your growth. And so thus, that baby idea formed in my head that maybe instead of building one of these companies myself, I could build an insurance company instead. And I spoke with some of the partners at Clyde & Co. and they did reinforce that they thought that was a gap in the market. And so that was the sort of original thing. And then I met my co-founders there, Paul and Tom, who have the skills to build insurance policies from a sort of financial and technical perspective. And so together, that's what we decided to do. And the premise, therefore, has always been using insurance as an enabler to de-risk projects that remove carbon dioxide from the atmosphere such that we can enable greater flows of investment. And when I say greater flows of investment, what I really mean is that kind of institutional finance that comes from the types of institutions that don't invest without risk mitigation. And that's what insurance is. And so in terms of what we do, we are an insurance company. We function under Lloyd's of London, the world's largest insurance marketplace. In terms of the markets we operate in the carbon markets. So like I mentioned, we try and help incentivize flows of finance to scale high quality carbon projects that either remove or reduce carbon dioxide going into the atmosphere. And we do that via specific insurance policies and risk advisory services that address what we think are key risks in the market. For example, what we would term delivery risk. So if I'm an investor and I'm putting money up front into a carbon project in order to get it off the ground, I'm probably not going to receive a return on my investment for multiple years. And that return would be carbon credits. And so if I have, let's say I'm financing an afforestation project, I have at least 5 years before I get the sort of early return. And there's a lot of things that could go wrong in that interim period, from fires to frauds or insolvencies to political risks. And what we're doing is insuring our client, which is usually the investor, against the risks that could mean they fail to receive the credits they expect.
That was beautiful. That was a great explanation. And okay, so the primary insurance purchaser for you guys is the investor, but do you also work with project developers? And are there any specific project types that you focus on primarily?
Yes. So you are correct. We usually do investors. That is probably the majority of who is interested in the insurance. I think a lot of the investors, when they are interested in insurance, like to have the power of being the insured party. So if you have purchased the insurance, you can work directly with the insurance company when you need to make a claim, and the claim is paid out directly to you. And a lot of them would be looking at actually how do we use insurance as a means to leverage our investments in these projects. So instead of investing solely off balance sheet, you can insure it, and thus you have additional capital to deploy more widely. So it usually is the investor, but we do also work with the developers. So it depends a bit on the type of insurance that we do. So for example, the developers are very well suited for political risk insurance. And this would be insurance that would be for CORSIA eligible credits. So for example, if you have a letter of authorization and you're looking to insure the risk that authorization is revoked, which would lead to a revocation of the corresponding adjustment in CORSIA eligibility, that's an insurance policy that can be applied to the investor, but also applies very well to the developer. Likewise, that policy can insure them against the more standard political risks that they might encounter, such as an expropriation or an export license cancellation or a forced abandonment or sort of a discriminative tax applied to their project, as well as maybe war, terror, civil unrest. That means they can't get to the project and thus they can't maintain it and suffer a loss.
Mm-hmm.
That policy, for example, is perfect for developers. Likewise, we work with developers on risk advisory services. So a lot of them will have investors who would like to know if the project is insurable or if there are any other risks to this project that should influence their investment making decisions. And so we will often work with developers who would like to have a risk assessment of their project. If that risk assessment is positive, they could put it in their data room to show good risk management to their investors. And if it has some challenges, then those are points that they could work on to improve their project again to make it more bankable. And then finally, I suppose we do speak with a lot of developers who introduce their investors or buyers to us. So we tend to have very close relationships with developers on that front as well.
Mm-hmm. And from the investor standpoint, well, I guess from like the whole ecosystem standpoint, you kind of said part of the reason that why you got into this to begin with was because nobody was really talking about insurance for carbon credits or carbon credit projects. Obviously, that is changing, albeit I would say that a lot of people in the space still don't really think about it. But if we go back to the investors, because there is that inherent risk in investing in carbon credit projects, have you noticed a trend of more investors requesting insurance before they invest in projects, either at the early stage or at any point along the way? Is this something that's becoming more common?
I think it is becoming more common. I think there's also a perspective to be applied there. I suppose when we launched our first policy live to the market in January 2023, I think broadly speaking, no one was buying insurance. So really the only place to go was up. But it definitely has gone up. I think so in 2023, a lot of people came to us quite speculatively. Like they wanted to understand the insurance. They wanted to understand what kind of price point, but they didn't really have a relevant transaction they were looking to insure. I think where we've certainly seen change now, probably two things, quite a few things, but certainly the first point I'm going to raise is one is we've seen an increase in, I suppose, more sophisticated financial investors coming in. So when you have your commodities traders, you have your specialist asset managers. We're seeing more larger financial institutions enter the space as well. We've also very much seen an improvement in the underlying contractual terms of these deals. So there's still not a huge amount of standardization, like each deal is very much its own deal, but the underlying contractual terms we can see have greatly improved. So when we started, a lot of the contracts we saw, actually, we didn't think were insurable contracts. Now almost all of them are insurable contracts. We can come back to LOAs, which still suffer problems in this area. But your sort of standard deal contracts are very good. And so I suppose that's to say that I guess the underlying deals are more insurable. The types of companies that come to us now and that we see coming in to invest in the market are the types of companies that you would term as insurance buyers. They are looking to get a return on their investment, but they're also looking to do so in a way that provides risk mitigation and that they can get past their investment committees and that they can feel like they're safeguarding their shareholder interests. And so we are very much seeing a increasing pipeline coming our way. And we are very much starting to see now deals that state within the deal that insurance is mandatory. So if insurance cannot be achieved, then the deal will not be approved by that business's investment committee. And so I do think this is a trend and one that we are, from our perspective, it's positive, but I also do think it's positive from the wider perspective of the market as well, because it does provide a safeguard, and that safeguard enables more money to go into the underlying project.
Right. And that's kind of what my intuition was telling me anyways, right? Because in the conversations that we're having at Gordian Strategies, we have over, I would say, the last couple of years seen also a growth in the sophistication of the investor. And it just makes sense that this would trail that or eventually become a part of those conversations from kind of day one, right?
Yeah, exactly.
So I'm not surprised. And it's a good thing, as you said, in terms of like unlocking capital and giving projects more room to grow, essentially.
Yeah, I always think of it from just like insurance, I think sometimes makes most sense when you apply it personally, because the same rules apply to a company, but it's like my bike versus my husband's bike. You know, my bike is this crappy one that I ride to the station, and I don't insure it because if it got stolen, I could easily afford to buy a replacement bike of the same quality. My husband has this kind of racing bike that, you know, he does triathlons with, and it's quite expensive. And if he lost it or if it got stolen or damaged, you know, it would be a financial burden to our family to replace it. And so it's an insured bike. And I think it's the same principle here. If you're going to invest small amounts into a carbon project, that's probably something your company can just take. You know, you can take the hit on it. It's not financially relevant or material to you. But once you start looking at sizable investment sums, companies just don't want to take that on their balance sheet and just eat the loss. They are much more interested in insuring it. And so I think that's exactly like you said. We're seeing more of those types of entities come in who wish to deploy that types of capital. And insurance is certainly going to be one of the things that they at least investigate, if not mandate. That is part of the deal.
Which is great news for you all.
But yeah, and I do truly think it's good news for the market, because if you need billions of tons of carbon dioxide to be captured from the atmosphere, that requires billions, if not trillions of dollars to be flowing into the underlying projects. And the only entities that have that type of money that could feasibly deploy, in essence today, which are, you know, the timeframes we're talking about, are those kinds of financial institutions. And so I do hope that we, as well as our peers, can be enablers for that. That is the goal for us.
Yeah, well, it certainly seems that way. And as you said, it's positive for the market overall.
I realize I didn't answer two of your questions. The one about project types and how early stage. Do you want me to answer those, or are you?
Yeah, please go ahead.
So I thought just quickly on project types. Across our insurance policies, we do almost any type of carbon project. We'll have some that we might prefer to not do too many, but we do for political risk, for example. We could do any type of carbon. It's really much more around the host country and the letter of authorization. For really early stage projects, and this syncs with the other question I didn't answer, most investors come to us with really early stage projects rather than those, you know, it's almost all ex ante and very much free issuance.
Okay.
So we can do for really early stage ones a counterparty risk protection. So really ensuring the investor against the counterparty, the insolvency, the abandonment. That again is project type agnostic. We're more looking at who the counterparty is, their experience, their financial track record, etc. For our widest cover, which is our delivery risk policy, this is where we do have limitations in terms of the types of projects we cover. So we do all forms of forestry. We do biochar, we do enhanced rock weathering, we do mangroves, we're expanding to soil grasslands now. So we're always sort of expanding, but we don't do every type, and we probably never will do every type for that delivery risk policy. But for the other types, political risk and counterparty, we can do any type of carbon.
I think we could probably have an episode completely dedicated to the political risk part of this topic.
Oh, 100%.
Which, as you have seen, especially with LOAs and now Article 6 essentially up and running, and a lot of governments that are entering the game, whether that's developing their internal frameworks of how carbon markets are going to work on like national level or the subnational level, but also just kind of everyone's figuring it out as we go. And each country is in a different position or a different level of sophistication in terms of how they're building this out. So I might have to call you back up later and we can do an episode completely dedicated to that, because I think that would be a fascinating one. And there's a lot of questions to be asked and a lot of snuffing through the answers.
Oh, 100%. And if you want an even better podcast than me, within our team, we actually have a lot of very specific political risk experience. So our senior underwriter, actually just promoted to head of underwriting, is from a political risk insurance background. Our general counsel used to work with me at Cloud & Co., but again, used to run international arbitrations around political risk. And so they can provide not just the carbon markets perspective, but really a nuanced take of how carbon markets, political risk, insurance policies within the carbon markets focused on political risk apply here, but also how they link to the wider political risk insurance market. And one of the things that we think a lot about, and this very much sinks into the LOAs, how do you create an insurance policy for CORSIA and political risk within carbon that is specific enough to the requirements of the entities within the carbon markets, but also still understandable to that wider political risk market? Because when you're talking about, we need basically every project to have some form of LOA protection if they're going to be eligible for CORSIA, we're talking about huge amounts of scale. And in order to get that scale, you need to have insurance that translates to people outside of the very specific carbon insurance market. Mm-hmm. So that's something we think about a lot. And on the LOAs, I mean, you guys will know very well, probably the vast majority of them are not insurable. They don't have the legally binding clauses, abilities to go to dispute resolution, very clear sort of responsibilities between each counterparty that you would expect. And this is something that I think there needs to be a lot of, I mean, everyone knows this, there needs to be a lot of work on, but within the insurance space, we would see it as our role to try and help our clients, as well as the wider market, to understand what are the requirements of the insurance industry for an insurance policy to back these types of documents.
And as you said, there's a lot of work to be done there. So I might take you up on the offer and circle back to talk with your colleagues specifically about this for 60 minutes or something. So last year, Kita announced a new product, the risk monitoring service. Why don't you explain that to us?
Yeah, of course. So it's the active risk monitoring. It is basically, so in order to be an insurance company, when projects come to us, we do underwriting, which is in essence assessing the relative level of risk of that project against other projects. And that will influence the price of the insurance policy. So this one is 1% and that one's 4%. And, we have to compare them against each other across a wide range of risk metrics. Within other insurance markets, one of the things that insurance companies do, in addition to selling insurance policies, is they actually also help companies to identify the risks within their projects, because the insurance company has a lot of information on those risks due to the act of selling insurance. And so what we're looking to do here is, in essence, help our clients to identify the insurable risks within their projects so that they can get a sense of that level of relative risk of their project versus their peer type projects. And that can enable them to either improve the project, which from our perspective, if we were to later insure it, it would provide a safer insurance policy to us. And then likewise, from the investor's perspective, to be able to compare projects on more of an apples for apples type basis. So what we do here is three things. One is just simple risk assessment per project. So let's say you're an investor and you're looking at 4 different projects and you want to have insurance on these projects, you could come to us and ask us for an insurability risk assessment per project, which would come out basically identifying sort of the relative level of risk from an insurance perspective on each of the projects, which could guide your investment decision making. Likewise, if you had a portfolio of projects, you could come to us for that same thing, but applied on a portfolio basis. So we'd be looking across your portfolio, helping you assess new projects that come into it, and then helping to assess the changing risk levels of your portfolio over time and providing that kind of reporting back to you such that you can understand those relative risk levels. And again, this is all coming from our underwriting model. And then the final thing, which is more of a sort of value add, but is part of it, is that if a client does buy an insurance policy from us, a lot of our insurance policies are multi-year policies. And so from our perspective, we can't just sell a policy and then forget about the project. That's exposing us to too much risk. Mm-hmm. So we will continue to monitor these projects just for our benefit. And that monitoring is provided back to the client as a value add. And so if you purchase an insurance policy, in essence, you can then get ongoing value added monitoring of your project, which can provide you some peace of mind. And so all of this is incorporated within those active risk monitoring services. But again, it's very much something that's common to insurance and other insurance markets. We're just applying it to carbon. It's really just a good form of risk prevention that helps to create better projects and then safer insurance.
Well, from both a product and a service perspective, that is extremely comprehensive.
The good thing about it is we have to have these underlying risk models. We have to be improving them all the time because it's core to our own business. And so it's just applying what we do internally and translating it to a forward-looking client perspective.
Right. And so I also read last year that you all had entered into a partnership with a UK-based carbon standard, Wilder Carbon, to ensure their buffer pool, which I thought was actually very clever. So why don't you tell me about that partnership and what that coverage looks like for the standard?
Yeah, of course. Framing on this, I think there's always a lot of discussion within the voluntary carbon market as to the carbon standards and buffers and what are they and do they function and how do they work and all of these things. And I think every insurance company, but certainly us, if you look on our website, which I guess you've done, you'll see we have quite a lot of reports that we've put out on carbon standards and buffers, because the view is always, in essence, the buffer acts as a kind of inbuilt insurance mechanism.
Right.
But it's not an insurance policy, right? It's not done by a independent insurance company. It's not subject to any form of regulation or, solvency requirements. The risk generally isn't assessed on an actuarial basis. So from an insurance company perspective, looking at a buffer, I think the immediate thing you think is, oh gosh, insurance could really provide a complementary role here. The question is just which role should it play? And so from our perspective and our work with Wilder Carbon, one role that insurance can play is actually as an insurance wrap around the buffer. So right now, if the buffer were to deplete, and not just Wilder Carbons, if you had a really bad year where you had just, your largest project developers all fail or some kind of catastrophic event, your buffer feasibly could go all the way down. What the insurance does is wraps it and says that if the buffer depletes past a certain level, the insurance tops it back up. And so in essence, your buffer cannot deplete. So from the perspective of the end user of the carbon credits, the buyer who is trusting the buffer, it provides them that additional level of security. More than that, it can also provide them with more detail. So one of the questions that buyers will often have is how does this buffer work? How do I know that there's been a reversal? How do I know if I've suffered a loss? I don't understand it and therefore I don't trust it. The insurance can be provided, in essence, a sort of certificate of insurance to the end buyer to note how they are covered. The insurance can also provide regular reporting back to the carbon standard to be deployed back out to the buyers to note, has there been a reversal this year? Has it impacted upon the buffer? And how has that loss been compensated? So I think and this is the Wilder Carbon policy, is a essential wrap for a carbon standards buffer, I think is a logical thing. Likewise, that is complementary to a potential for insurance for the project developers themselves. So I think if you were to recreate the carbon markets with insurance available, I'm not sure you would have put a buffer in place. In the first place, you might have just put insurance at a transaction level. And so that also can be added to this. You could have project developers who could utilize insurance to reduce and or remove their contribution to the buffer and to swap that out with insurance. And so I think these are things we are working with Wilder Carbon on the buffer insurance policy, and then we are working with a variety of other standards in terms of how do they incorporate insurance into their standard. Corsia insurance here also applies to this conversation. And then I guess the final thing that we do with carbon standards and buffers is what we call buffer as a service. So before I just explained our sort of risk advisory portfolio management, think of it as the same thing, but for a carbon standard and its buffer. It's outsourcing the, in essence, risk advisory that they're doing now. We would help them to assess the projects that come in to determine the level of contribution to the buffer, as well as to manage the ongoing sort of risk assessment of the buffer and provide that regular, transparent reporting back. So it's sort of before you get to your insurance, you might just actually want to understand what is in my buffer, what are the relative risk levels, and how do I put the risk metrics per project into a way that can be regularly and quickly assessed and checked as my buffer grows and evolves over time. And that's something also that we've been working with some carbon standards on, where One Shot and ICR are two examples that are public.
That's very smart, actually. I mean, it makes sense to kind of get ahead of it in that regard from the standards perspective.
Yeah, I mean, that's our thought, that it makes sense to get ahead of it. I think we always, going back to the sort of original point of why we started, it is because we really wanted to have a positive impact. And so our hope here is that it's a helpful thing. I think most standards do not have in-house actuaries. Most standards do not necessarily have in-house, really heavily experienced sort of portfolio management, financial and or insurance people. And we do, it's what we do. And so it's the ability for them to cost efficiently pass some of that existing burden to us, where that is our bread and butter, our day to day, and we can do it more efficiently and more cost effectively for them than them needing to do it themselves.
And you probably know much better than I, but I haven't read or learned much over the past couple of years about standards insuring their buffer pools at all. So I feel like there is a real big opportunity there, and maybe this partnership could be one of hopefully many down the road, because it seems almost, well, it's kind of, as you said, like if you were to reinvent the markets, maybe those wouldn't exist because the insurance would play that role, but that clearly hasn't been the case. So, we have to adjust to the current reality, which is what you all are doing, is insuring the buffer pool that has been in existence before the idea of providing that insurance or going that route even was something people were talking about.
Yeah, I mean, that's actually exactly, we're sort of like, the buffers exist. In my mind, they are a liability. You can argue how much a liability, but they have an aspect of liability to them that is, I think, difficult to ignore.
Mm-hmm.
And so, whether you want to phase them out, or which is wholly possible, insurance is a means today to safeguard them while we figure out sort of what we could do with them over time.
Right. And each standard, of course, has their own requirements on how big that buffer pool needs to be. And then, of course, ICVCM, any standard that applies for approval from their core carbon principles, ICVCM has a standard or a threshold of how large the buffer pool needs to be. So there's also just not any uniformity on a standard by standard basis in that regard, but at least from ICVCM but all these other standards can go about it currently however they would like.
Yeah, I mean, it is really confusing. We have this huge sort of database that looks at each carbon standard and what their buffer covers or doesn't cover across all these different aspects. I mean, it's really confusing. I think from the end buyer's perspective, I can understand why they just don't trust it, because it's perplexing.
Yeah, right. It's true. So, okay, we are, January 13th? We're at the very beginning of 2025. So why don't you tell me, what does the rest of the year look like for Kita Insurance?
So, I mean, we expect 2025 to be a pretty busy year. I think what it looks like, broadly speaking, you mentioned at the beginning, are we seeing an uptick in insurance interest? And we are. So I think this is a year in which a lot of our clients last year were looking at small pilot transactions. It might have been the first one that they did, but they've always had more capital to deploy. So I think this year, our hope is that it is the year of the big deal. The deal that needs that kind of insurance syndication, a really sophisticated structure. And I think that is what we expect to see, which would be very exciting. Likewise, on the political risk side, I think this is a year in which we will all be watching, how Corsia goes, but very much from the insurance perspective, we'll be hoping that the LOAs and the sort of other sort of readiness of host countries moves forward so that we can apply that insurance, which as of now, at least is required for Corsia eligibility. And we always see that as part of the wider education role we hope to play in the market. And then I suppose, again, we do think there's going to be some interesting movement on the carbon standard front with insurance. So whether it is buffers being insured or whether it is increasingly project developers being able to buy insurance to replace their buffer contribution, I have hopes that this is a year in which that will move forward, because I do think now that insurance is becoming more available, it's a logical thing to look to deploy in that space. And I suppose, all of it, I think, is it's always an interesting market. I think this will be an interesting year. And all of those things also touch upon, again, as we started with, increasingly sophisticated financial players entering in and looking to deploy capital in a way that they're used to, with the same risk mitigations, the same deal structures, the same ability to take, underlying security, et cetera. And I think that influence is going to increasingly impact positively upon the market.
I think you're very much correct across all of those fronts, right? Because we have the Article 6 carbon credit mechanisms in place. Corsia, it is in its current phase and it's growing. We now have about a year of the carbon market integrity standards behind us. So we're starting to see the fruit of that work. So it does feel as if 2025 will be this year where we see a lot of development and hopefully growth, because all of those building blocks that have been kind of inching towards the finish line, they've now more or less crossed the finish line. And so this is the year of all of those going forward together. And there's a lot of action. And so I think that there's great potential as these have now finally been released to the world and the market is starting to learn and understand how to navigate them.
Yeah. Fingers crossed.
Fingers crossed. Yep. Fingers crossed. All right, Natalia, I always close out the episode in the exact same way, and it's asking a question, a form of a question from Epictetus, who was one of the finest Stoic philosophers of history. His original question is, or I guess it's a statement that I've turned into a question. He says, "What concerns me is not the way things are, but the way people think things are." And so I like to use that to then ask my guests, what do you think is one thing that must be done to change how people think about climate finance?
About climate finance specifically, not about climate change. All right.
You can go for climate change if you want.
Well, my climate change one is relatively simple. I think people think that things are at a stage where there's nothing they as an individual can do. I would always say that individual actions matter. And so that each individual should figure out what they can, if they care, figure out what they can do, whether it's small or whether it's big, but each individual actually does matter. And I think people tend to feel like they don't. That would be my sort of climate change one. On climate finance, I think sometimes people think about it as this might sound odd, but I feel like sometimes people think about it as it's the right thing to do and the good thing to do. I think I would prefer to have people think that more in the terms of sort of risk and return. And I say this when I used to work at law firms, I actually used to get quite frustrated that we never talked to clients about the right thing to do. It was always about, risk and the sort of, legally, are you allowed to do this, or legally, are you not? And it used to frustrate me. But law firms, and all of a sudden you would see, when you're talking about climate change, you'd see the CFO and the CRO come in because they were worried about the risk and the liability and they wanted to capitalize on the opportunity. And that's when you saw action happen. And so I think with the carbon markets, I think people still sometimes view finance in this space as more of a maybe charitable endeavor, maybe something that should be the right thing to do. And as long as you think about it that way, as honorable as it is, it sits in a pool of capital that isn't that big because, the sort of capital that goes towards philanthropic means usually stays quite small. I think as soon as you can translate it to the risk of the business, so what liabilities do we have in this space? How do we look to identify and manage those liabilities? And then is there a means via which we can flip those liabilities into some form of opportunity via which we can make a return? If you think about it in that way, then I think finance within the carbon markets can become much more appealing. And so I suppose, I can't remember the exact quote that you said, but the sort of shifting the thought process within corporates in that direction, which inherently means getting your CFO and your CRO, et cetera, involved. I think that is a direction I would like people to shift their mindset.
Well, from both your climate change and your climate finance answers, we could make this 2025, the year of individual actions that contribute to the greater good, and 2, the year of de-risking.
Yes, there you go. Well summarized.
Great. Well, that was a fantastic response. I appreciate it. I always like to joke and say, I think Epictetus would be proud of your answer.
I'm sure you say that to everyone.
No, that's not true. That's not true. But anyways, that's it on time. Natalia, I really appreciate you connecting with me. This is the first conversation I've had with anybody about carbon credit insurance, and I think it's a really excellent topic. So I imagine that our audience will take a lot away from this one.
Well, thank you very much for having me on the podcast. It's been a real pleasure.
All right. And that's a wrap on today's episode. A huge thank you to Natalia Dorfman for shedding light on the role of insurance in carbon markets and why it's becoming an essential tool for unlocking climate finance. And of course, a massive thank you to all of you for tuning in. You know I appreciate every listen, every share, and every conversation sparked by this podcast. If you've enjoyed the conversation, please make sure to subscribe and leave us a review on Spotify or Apple Podcasts. And if you're on Spotify, you can hit the little bell icon so you never miss a new episode. Also, if you're looking for more insights, check out our weekly newsletter Sliced for quick, digestible updates and insights on carbon markets, climate finance, and sustainability trends. Each week, the newsletter is also released in podcast format on this channel. If you've got thoughts, questions, or if you just want to connect, shoot me an email at jtipton@gordian.strategies.com. I'd love to hear from you. I'll be back next month with another deep dive into the world of climate finance. Until then, stay curious, stay engaged, and stay vigilant, and keep pushing for a more sustainable future. This podcast is brought to you by Gordian Strategies, and I'll see you next time.